the test does focus on this, they usually refer to the rebar book, because the rebar book has some tables in it that deal with splices or deal with slings and how you determine the load from a spreader bar. And that's something you'll look at in the vertical construction section. The next section on your outline, item J, now returns us to the concept of general employment or employee laws, and returns us also to Chapter 5 of your Contractor's Manual, and back to the table of contents in Chapter 5. And we are looking at J, the right to know law, and that is on, in my book, 5.6 at the very bottom of the page. And the idea here is that we are supposed to have an MSDS, a material safety data sheet, on every type of product that is considered to be hazardous. Now, there are approximately 10,000 chemicals that are manufactured for industrial purposes worldwide. Of these 10,000 chemicals, approximately 5,400 of them are considered to be dangerous in some way. And of the 5,400, about 980 of them actually have established PELs, which are permissible exposure limits. These are the limits that OSHA sets as to how much of the material you can be exposed to before you get ill in some way or die. The point here is that you've got an awful lot of materials that may need to have MSDS sheets on them. And you might not normally think of these things, even caulking, even plywood. These things have materials in them that under the wrong circumstances can harm someone. And an employee has a right to know. And in particular, we're supposed to keep these MSDS sheets for 30 years. And so we have an obligation, number one, to inform the employee and to have that information available so that they can take precautions if they need to in the material. And this right to know law applies to all employees at all tiers. So as a general contractor, if you hire a subcontractor, you are responsible to make sure that those subs, if they're working with hazardous materials, have had an opportunity to see what they're working with and to know how to safely deal with whatever they're working with. And that is the MSDS sheet and reviewing that sheet. Item K in your outline deals with unemployment benefits. And the point that's often perhaps asked about here is how long we have to keep records for this, and that's 5 years. Number L goes and talks a little bit about workers' compensation. Now, workers' compensation is an entire subject in and of itself, just like OSHA was. And workers' compensation has its own chapter to deal with. So what we're going to do is take a look at the worker comp chapter and look in more detail at the workers' comp regulations. And that's Chapter 6, which is the first chapter of the second volume of Big Blue. So take out that and let's take a look at it. If you look in your contractor's manual to the 6th chapter, look at the table of contents, we're going to explore workers' compensation in a bit of detail. And you're going to want to take a look at your outline as we go through this chapter. If you look at the table of contents, it's pretty self-explanatory. It doesn't list a lot of differentiations. Keep in mind that you have both the commentary of the author here and the statute. And that's also true, for example, in the OSHA chapter. You've got several different tables of contents. But what we're looking at right now is the commentary of the author. There also is the table of contents dealing with the statute. If you can't find it in the commentary, well, then you would get it for it in the statute. We're actually going to go through page by page here, so open to the next page. In my book, it's 6-5, where it deals with an introduction and when is workers' comp necessary. And the bottom line is, in general in workers' comp, you don't have to have workers' comp unless you have more than 3 employees. However, construction is an exception. In construction, you have to have workers' comp if you have even 1 employee. However, there is an allowable exemption for up to 3 corporate officers, but if the test were to ask when is workers' comp necessary, the answer in construction is if you have even 1 employee. If you turn to the next page, 6-6, they're discussing a little bit about who's going to be eligible or needs to have workers' comp and who would be exempt from workers' comp. And you'll notice that under exempt, they're not saying that these individuals do not have to have the workers' comp. They're saying that within the context of the word construction, they're not regarded as construction activities. And so they follow the general guidelines of needing workers' comp if you have more than 3 employees. But in construction, we know that we need it if we have even 1 employee. But they list 14 different types of exemptions. After they're done listing these exemptions, the next paragraph indicates that the subcontractors are the statutory employees of the general contractor. What that means is that the statute says they're your employees. So you've never met them, you don't know them, you don't have anything to do with them, but the statute says they're your employees. Therefore, if you hire a sub and the sub does not carry workers' comp, and the employee of the sub gets injured, well then that employee has the right to claim against you, the general contractor, their claim for workers' comp. But if you don't have workers' comp, then they can go after personal assets, and so that's something that is very careful of. A lot of individuals who become contractors assume that they can get the exemption from workers' comp and simply make sure that everybody else in their tier has workers' comp, and that's true if you investigate the situation thoroughly and you make sure that nobody walks on the job that does not have workers' comp. But where problems occur is when you have one person, the GC, who does not have a policy, and they hire people that are, quote, independent contractors, something that they discuss next on 6-7. And perhaps these, quote, independent contractors are themselves hiring people to work, and everybody in that arrangement is trying to evade as opposed to avoid the workers' comp law, and something goes wrong, and then, of course, whether individuals have exemptions or not, these exemptions may get challenged because the employment relationship was such that they should have had workers' comp on these individuals, and then that can go back to the GC and create problems. So if you're going to follow that route, you want to be very careful to make sure that you know for sure that every individual working on your job is covered by a workers' comp policy. On 6-7, as I forecast, the next description here is that of the independent contractor, and you'll remember the tax laws talk about the independent contractor, the licensing laws talk about such a person, and here again we're talking about how to correctly classify someone. A true independent contractor has the right to exempt themselves for workers' comp, but then they cannot turn around and hire anyone unless that person has workers' comp, unless they have workers' comp on that person. If they in turn hire other independents who claim they are exempt, even if they show you exemption certificates, could create a risk for the general contractor, and you want to be very careful about that sort of thing. Turning to 6-8, looking at the fourth paragraph from the top, it does again reiterate that some employees do not need to be covered with workers' comp, and here they're talking about domestic servants and so forth. And also, 2 paragraphs below that, they define casual employment and indicate that workers' comp is not needed there either. The next paragraph under that is talking about how you select the type of policy. And what's in italics there that's important is that the employee cannot be required to pay any portion of the premium. The first alternative or method of workers' comp that they suggest on 6-9 is purchase an insurance policy. And frankly, this is the best way to go about it. The problem is that sometimes it's hard to buy workers' comp, or the premiums are too excessive, and so people try to create exotic circumstances to overcome these objections. In reality, nowadays, a way to look at your situation, and perhaps an idea for you, is to look at employee leasing as an alternative. As a construction company, you can go into an employee leasing arrangement whereby you cover everyone in your organization and you cover yourself with workers' comp, and you also purchase an additional policy referred to as a dead man's policy to make sure that nobody falls in between the cracks. Now, the way in which insurance works in workers' comp is they forecast the premium and then verify their forecast at the end of the year by looking at your payroll. The forecasted premium is based upon the rating of the individuals that you're hiring. And so, for example, a carpenter, a general trim carpenter, for example, might have a rating of 30%. And that means that you're going to pay 30 cents on the dollar for that person. You're going to pay 30 cents in workers' comp premium. Now, this rating could also be modified. If you were in a company that had a high risk because they had a lot of accidents, there might be a modifier added onto this. And say the modifier was a 2. Well, that would mean that the normal rate for your carpenter is 30 cents on the dollar, but you have a 2 modifier, so now you're going to pay 60 cents on the dollar for your carpenters. Well, that's just a forecast. At the end of the year, they total up all of your payments to all of your people, and they verify that you have paid enough workers' comp on them. They also will look over any payments made to subcontractors, and they will ask to see certificates of insurance from these subcontractors. If you can't provide these certificates, then they will come after the contractor for the premium that they feel they've missed for these individuals that have been working without proper coverage, because they're going to argue that if something went wrong, they would wind up having to cover them anyway. And so that's how the workers' comp premium essentially works. On page 6-10, they speak about self-insurance pools or funds. Now, as a personal note, I will tell you that I think that these arrangements provide a level of risk that is really not clearly disclosed usually by those that market these products. If you read this section carefully, you're going to find out that these self-insurance pools are basically individuals insuring themselves. In my book, that's really not insurance. You ask yourself a question that you may find interesting. How come when you pay your bills at the end of the month, you pay a premium to your insurance companies? Everything else is called a bill. Why is an insurance bill called a premium? Because insurance companies have a way with language. They have used language in particularly important and useful ways to their industry. In the same way, self-insurance is not insurance. If you join one of these groups, you are on the hook for any losses the group sustains. And in fact, they describe here that there are two basic types of self-insurance funds in Florida. This is the second to last paragraph on page 6-10. The first part is issued by the Department of Labor, and the other is issued by the Department of Insurance. The Department of Labor bases the individual's liability on the phrase joint and several. That means together and separately. So how would you like 3 years from now to find out that the pool you were in closed and that they had a loss, and they send you a friendly letter in the mail, congratulations, you remember the pool 3 years ago, we lost $1 million, enclose your check. In that type of arrangement, you are jointly and severally responsible for any shortfall of the pool. The other type of arrangement, the type by the Department of Insurance, at least creates the phrase jointly and proportionally. So you are responsible, but only in proportion to everybody else. And so there's a little bit more security there. But be aware that these funds may not be for you, and you really want to make a very cautious decision about how you are going to deal with this workers' comp issue before you go forward. For the exam, however, realize that they list self-insurance as options. They tell you the two different types. They show you how these two different types assess risk differently, and that's what you might be needing to know. On page 6-11, the next major topic is individual or freestanding self-insurance. Here they're talking about a big company that can insure itself. And the second paragraph indicates that such a company has to have net assets of at least $500,000 and their total assets of at least 3 times the annual premium they would have paid. And so the idea here is that they can get around, in a sense, the need to buy a policy by putting up their assets and insuring themselves. On page 6-12 at the top of the page, they describe 24-hour coverage and miscellaneous coverage plans. They also refer under miscellaneous coverage plans as a wrap-up policy. These are sometimes asked about on the exam, but the point is these are options. The 24-hour coverage is an option, but is not part of the workers' comp system as of today, although it may be one in the future. On page 6-13, they describe penalties for not having the workers' comp. The second paragraph indicates that you can be fined up to $100 a day, and they can assess a $1,000 penalty. And if you willfully fail to secure this compensation, you can have a $5,000 penalty assessed against you. And so there are a series of potential penalties involved with workers' comp. Also, you'll notice that the last paragraph above the line here on this page, 6-13, it's indicating that if you didn't get workers' comp and you bid on a job, and the reason why you won the job was because you didn't have workers' comp, so you could bid a lower number, that not only would you lose the bid, but you also could have damages assessed against you, 10% of the total amount of the bid, or $5,000, whichever is greater. On the bottom of 613, they describe the responsibility of the employer, and on 614, they're describing the process of reporting things accurately. And on the 1, 2, 3, 4, 5th paragraph from the top, they say if a prospective employee lies on the pre-employment application about prior medical problems, then benefits can be denied to them because of their untruthful statements. Also, if you do not report accidents in a timely fashion, then you might be responsible for up to a $500 fine from the department for failing to do that. The process is that if there is an accident, you have, of course, the OSHA reporting, but now you have the workers' comp reporting, and the timelines are slightly different. The timelines you'll see later on in this chapter here. Also, what happens is you refer the individual to a physician, and once they're referred to that physician, only the physician can unrefer them, so to speak. Only the physician can send them back to work. On page 615, on the fourth paragraph from the top, they describe the basic benefit to workers' comp is that they are allowed up to 2/3 of their average weekly wage. That's the basic benefit. Now, this is going to be modified by a number of things. The first thing is that if a benefit is given in Florida, it cannot be more than the Florida weekly average, which is approximately $325. So if a person was making $300 a week, they would get 2/3 of their salary. But if they were making $5,000 a week, they wouldn't get 2/3 of their salary. They would get the Florida weekly average. Also, this is going to be adjusted as to whether their circumstance is permanent or temporary. If it is permanent, if they can never go to work, then they're going to get this 2/3 for the rest of their life, plus a 5% cost of living increase. And the next paragraph indicates that death occurs, they get $100,000 in a death benefit, and they get $5,000 in funeral costs. That is to say, the family does. The bottom of the page 615 indicates that there could be as much as a 25% reduction in compensation benefits if the safety rules of the employee have not been followed. If the employer has put forth certain safety rules and the employee does not follow them, that a reduction can occur. And also an odd fact just listed here that the injured worker has 30 days in which to tell the employer that an accident did indeed occur. Looking on 616, they now describe what are you going to do after this accident. And the 1, 2, 3rd paragraph from the top of this page indicates that if you don't follow the rules of reporting and you don't report within 7 days of an accident, this is not a death but an accident, then there can be penalties assessed against you. And also, the 2 paragraphs under that, it starts out, it should be noted, however, that the accident has to be reported on a notice of injury. So that's the name of the form. And that, again, it repeats that you have to have a 7-day notice, and if there is a change of status, that also is required to have a 7-day notice. The paragraph under that says that if there's the death of an employee, that has to be reported within 24 hours. And that all information, the next paragraph, contained in the first report of accident must be kept as a copy for no less than 2 years and 6 months. And if you don't do that, there's a potential penalty of $500. 616 at the bottom of the page has a bit of information which is sometimes asked about. It has to do with, we've talked about the benefit being 2/3 of the wages, but what monies are actually included in the wages of an individual? What they describe in the statute is that you go back, I believe it's 26 weeks to find out the average, maybe it's 13 weeks, you can look it up in the statute. But what is being discussed here is what's included in the amount of money that's considered wages. And what they're indicating here is that the wages that are earned plus employer-provided health insurance and permanent housing. And then on the top of the next page, they explain that, look, if a person's injured, and if you keep them insured with their health insurance, then they're still getting their health insurance. So you would not count their health insurance as part of their wages if you were still giving them their health insurance after they were injured. And so sometimes there's a math problem based on that kind of an arrangement. How do you determine the person's wages? Well, it's going to be everything, but if you keep the health insurance after they're injured, then you're not going to include their health insurance as a part of their wages in the calculation of what did they earn. Okay, also the next paragraph on 617 indicates that if intoxication results in the accident or there is a failure for a safety device, this can mitigate the claim to some degree. And that could be important in your arrangement. On the bottom of 617, there's a discussion of, well, you want employees to return to work. And so they describe in some detail this return to work program. And then on 618, they describe that Florida encourages this to the point where there can be up to a $2,000 fine if you do not try to return these individuals to work. The process of return to work is now described. And the process begins when the physician, it says, releases the employee back to work. And the employee is not required to go back to work until that is advised. Now, there's a discussion which goes on here called light or altered duty. And what they're talking about here is a person that goes back to work but cannot do the same types of work that he was doing before. And the assumption is that they're going to be paid less because of this. And the idea here is that there is going to be a modified benefit in this case, so that the person makes their adjusted salary, their new salary, plus they're going to get a little benefit. Now, in all cases, their salary plus their benefit can never exceed 2/3 of their original salary, and/or can never exceed the Florida weekly wage. So 325 is going to be the total benefit that anyone can receive if you consider what they're earning in their alter duty and also any workers' comp benefit that is paid to them. You'll also note on 619, the second paragraph from the bottom, that medical costs represent over 50% of all the claims, and so the attempt is being made here to reduce the medical costs for injuries, and of course that goes back to OSHA and preparing a safe workplace for all employees. On 620, they describe the financial impact on the contractor, and they indicate that there's a direct impact of workers' comp. And on 621, they describe how the workers' comp is calculated. And again, they tell you, and they put it in bold here, what we described before. You're going to calculate based on the size of your payroll, the type of classification, and the modifier, how the business compares with other business. They give you an example of how this would work in the next paragraph, so you can see how to do a calculation if you would need to. And this continues on 622, and they describe a roofer and show how this would work, and also describe that modifier that was described before. The next item in this chapter is the statute itself. And I'm just going to go through the table of contents of the statute, and I'm going to point out the topics that have sometimes come up on tests like these. And instead of saying 440 point, I'm just going to say the point. So for example, when I say .021, what I'm referring to is 440.021 exemption. So the first thing to mark is exemptions to the law. The next stop here is .06, what happens if you don't get the compensation. Then .09, coverage. Then .102, the drug-free workplace. .103, building permits. .105, prohibited activities. And then, of course, fraud reports right underneath that. Then .134, workers' comp managed care arrangement, and that's like an HMO style approach to workers' comp. Then .14, determination of pay. Then .15, compensation for disability. Then .151, occupational diseases. Then .16, compensation for death. Then .185, notice of injury or death. .191, the Ombudsman Office. Ombudsman is just sort of a fix-it-all, somebody who can handle problems. .20, time payment for compensation, penalties for late payment. .205, coercion of employees. .21, invalid agreements. Turn to the next page. .24, enforcement. .28, modification of orders. .35, record of injury or death. .49, limitation of liability through special disability trust fund. .491, reemployment of injured workers and the rehabilitation process. And this sums up the workers' comp issue. This returns us back to our outline and returns us back to Chapter 5 of the Contractor's Manual. Finished